I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Today's podcast forms the second and final update on the fascinating 1/1 reinsurance renewals we've just been through. Whereas episode 283 with David Flandro was all about delivering a high-level analysis of the global macro picture, this one is designed to focus in on detailed market specifics from a reinsurance broker's perspective. For that, we need a broker of great renown and great experience. And that's why I'm delighted that Lara Mowery, Chief Commercial Officer at Gallagher Re, has been able to talk to me. Lara fits the bill perfectly and is not far off entering her fourth decade at the frontline of the global reinsurance market. I've been interviewing her on and off stage for over 15 of those years, and she's always combined a great ability to capture the essential temperament of the state of the market with the skill to communicate what she sees to others in a straightforward, no-nonsense way. With Lara, I've always come away with the impression that what you see is what you get. You may remember I spoke to her briefly as part of last year's Monte Carlo special documentary podcast, but I'm absolutely over the moon to be able to devote a full episode to her for the first time. Gallagher Re has a great 1/1 report out as part of its long-running First View series. These have become an institution and have been required industry reading for over 20 years. This one is no exception and is called Options and Opportunities. There will be a link to it in the notes. In this podcast, Lara is on excellent form and a listen will give you a strong and detailed idea of current market dynamics and what course reinsurance has set itself upon for the rest of 2026 and beyond. Enjoy the podcast. Lara, welcome back to the Voice of Insurance.
Thank you for having me. I'm, as always, thrilled to be here with you.
It's really, really good to see your face again. It's not as warm as it was when we last spoke back in Monte Carlo.
Not at all.
When you're at Monte Carlo, we're all looking forward to 1/1/2026. Now we're through that date. What happened on an aggregate basis to supply, demand and pricing? What's the result?
Of course. I mean, it's pretty straightforward at this January 1 renewal. Supply went up, demand didn't go up as much. Pricing came down as a result. And that's where we ended up across most classes of business and most geographies. Of course, you always have the color around that there's differentiating loss experience. And U.S. casualty is a bit of a separate topic on its own that I'm sure we can cover off at some point through our conversation. But largely things held up across that dynamic between supply and demand. One thing I would say is it wasn't necessarily solely a supply-demand issue, although everything at the end of the day comes down to that in some shape or form. But there are intertwining factors. The supply increasing was largely due to retained earnings. And because profitability was good and those retained earnings were accretive, there was incentive to redeploy that within the business. So not only did you have capital increasing, the reason it was increasing was because of good profitability and attractiveness of being in the business.
Of course, anybody listening who hasn't already read Gallagher Re's 1/1/26 renewal report should do so, and there'll be links to that in the notes accompanying the podcast. So I remember when we were talking in Monte Carlo, if I spoke to any reinsurance CEO, they'd be saying, yeah, I really like this. Obviously, they could start to feel some of that profitability coming through. They knew, barring a major catastrophe, which of course we didn't have in Q3, Q4, they knew that profitability would be there, that new capital would be there to be deployed, and they really wanted to deploy it. And they knew in order to deploy it, they might have to give up something. What did they give up? And do you think they gave up a bit more than they were expecting?
Yeah, I would say that as we worked our way through January 1, pricing did continue to become more competitive than you and I talking at Monte Carlo probably would have expected it to be. At the end of the day, I've heard a number of people say, and this might be particularly focused on some of the European pricing movement where swings in pricing haven't necessarily been as extreme over the course of years, that it feels like we experienced 2 or maybe even more than 2 renewal cycles all at once. But I think if you asked cedents, how they felt, maybe going back a couple of years, 3 years, they would have said the same thing. The direction of travel to them when pricing was rising and structures were tightening up really felt at that point in time to a buyer of reinsurance that multiple years of adjustment were happening all at one time within that very short renewal period as well. So at the end of the day, we did have really robust amounts of capital, and that capital was incented to participate in the business. And that did drive pricing to levels that we probably didn't quite forecast 3 months ago.
So in general, it was a better outcome for buyers of reinsurance than we had expected.
Yeah, I think that's exactly the right way to categorize it. Although from talking with reinsurers, I would say they also got a lot out of this renewal period. They were able to retain business they still view as adequately priced and attractive business. They were able to really work with buyers to tailor the way that the coverage was being structured to more closely fit with the buyer's goals and objectives. So that's just a great point in time when we can step out of a renewal process and say, buyers really had the ability to focus in on cost savings, but also think about the way they wanted to be buying coverage and come out of it in a pretty good position because the market was robust and responsive and had capacity. And where sellers of that capacity can look at that renewal and say, we're pretty happy with the outcome, all things considered. Would sellers love to be able to continue to uphold pricing levels through 2026 that they experienced in 2025? Sure, but that's just not economic law. Supply demand is going to create that market adjustment every time.
So we've had this adjustment, but both sides should feel reasonably happy in that the reinsurers, they're happy with the rate adequacy that they've managed to achieve, and then buyers of reinsurance were able to get closer back to structures that they feel were adequate for what they really needed.
It's a bit of a unique point in the cycle, Mark, isn't it? If we look back over the years of how business ebbs and flows, normally you've got loss activity causing a lot of stress and strain, or reinsurers getting to a point at the floor of the cycle where it's just really difficult to justify writing certain categories of business, or given maintaining a portfolio decisions they have to make in the risk reward trade-offs there. But we are at a point through this renewal where there is a bit of a balance. With fair warning, that balance is always ebbing and flowing and shifting. And there will be things that happen throughout 2026 to make us look back on this conversation and say, oh, well, that was an interesting thing we didn't foresee happening.
So in terms of, obviously at 1/1/23, we had a big restructuring. We did lots of years' work in one go, particularly around attachment points and where reinsurers kicked in to provide cover. What was being traded here? From what I've read, it looks like it was mostly price rather than structure.
Yeah, that's a fair statement. So when we talked to buyers about really focusing in on what the core objectives were going to be for their 2026 renewals, for the most part, that core objective centered around pricing efficiency within the core product that they were buying. And I think reasons for that really focus around the fact that pricing had increased a fair bit over a period of time. And this was an opportunity to pull some of that back in and normalize in buyers' minds the amount that they've been spending on reinsurance. But it also had to do with the fact that buyers now have had 2-3 years of an adjustment window to think about the way that they're structuring their own portfolios. And in many cases, insurers have de-risked the way that they're structuring their own underlying composition of business, whether that's been tightening up the amount of limit they're putting out themselves into the market, or of course, taking price increases, which we've seen on the insurance side across multiple lines of business, or thinking about exposure and concentration management and right sizing the way that their portfolio operates within the way they're buying reinsurance. So at this January 1, many buyers were well positioned to focus on price as the key objective.
So to summarize that, to say that 3 years ago, the reinsurers kind of handed this hot potato back to the cedents. And of course, in 3 years, maybe it hurt the first year, but they got better at handling it. They've obviously done a lot of risk management, got the equivalent of now wearing oven gloves, for example, we might say. And so they're more comfortable with the risk that they're retaining themselves and not feeling, or at least this was a risk that they didn't used to have to retain for a whole decade before that. But now that they've been forced to retain it, they've been forced to understand it and get better at managing that risk.
Yeah, that's right. And I think you brought up a really important point within that, which is the time horizon. There was very little movement in terms of attachment points and the way that buyers could purchase reinsurance for a number of years. You had the 10-year time horizon that you referenced, and it takes an insurance company a fair bit of time to restructure their own portfolio. They can't just snap their fingers and adjust to a new reinsurance structure overnight. And there was that 12 to 24 month plus window of time where insurers did have to take action because they were no longer buying the same type of reinsurance or buying reinsurance in the same way. But the same changes in the loss profiles that were impacting reinsurers and pushing them into having to make changes to the way that they were offering reinsurance based on needing to interact with their own management teams and boards and investors. Those losses were also affecting insurers. They're taking that first dollar loss. And so reinsurance was a catalyst in some ways, of course, but the fact that the way losses are happening was also a catalyst for insurance companies to have to say, we just have to do things a little bit differently. The way that we've been offering coverage at attachment point, as an example, is just not palatable any longer, or the way that we've been managing our exposure concentrations needs to shift. And so insurers, for their own reasons, also had to really tune into the way that those portfolios were constructed. It just takes a lot of time for that to play through an entire portfolio.
Yes, within the insurance reinsurance world, we forget that reinsurers can be more nimble than insurers, of course, because they don't have local regulation, admitted lines, or having to file new rates and redesign their policies and re-equip their sales force in the way that a much more people-light business like reinsurance, of course, can change much more quickly.
Exactly.
So if reinsurers perhaps giving some credit to their clients for having improved the underwriting and the quality of that underlying book that the reinsurer is protecting, and we're getting price discounts, what were those cedents generally doing with that price saving? Were they using it to buy more reinsurance, and whether that reinsurance was higher up or perhaps lower down? Or did they tend to pocket the savings and say, right, well, I'm just great, I'm just going to keep this money for something else?
At the moment, a lot of buyers have taken the savings and are thinking through what comes next. They didn't necessarily at January 1 say, I want to do X, Y, and Z with that savings. Now, there was definitely some of that at January 1, but again, there was more supply than there was demand. So buyers at January 1 didn't say, oh, supply has grown X amount, I'm going to throw a whole bunch more demand out there to match that. We didn't see those two things growing in the same magnitude. So one of the things that impacted how buyers were approaching the way that they were looking at using that savings was a little bit greater availability in frequency or aggregate type protections. And that was one area that we spent a lot of time exploring with buyers. One thing that I would say there is we didn't see any sort of market-wide wholesale erosion in the way that core programs are structured. So those attachment point changes that happened in 2023 have largely held steady. There aren't a lot of people saying we're going to reduce our first layer attachment point by 30%. And that's the program we're putting out into the market. There has been a little bit of that, maybe some adjustment here and there that's happened. But as a wholesale category of how programs responded, those core programs have largely held up. But what's now available is a bit more openness to conversation around supplemental coverage. So if a buyer wants to think about additional frequency protection, there's absolutely capacity that's available for that and conversations to be had. It's not necessarily the same type of structure that was available 5-10 years ago. It's much more bespoke in terms of a discussion with an individual buyer, what makes sense, what is important to them in protecting frequency. Can a structure be achieved that's attractive to a buyer where they feel there's enough value in that a seller is willing to sell? And a lot of that give and take really gets into the details of what has the cedent done to improve portfolio dynamics and digging into the data in a major way, which was a theme across a lot of the business this year, including casualty.
So it sounds like it's a much more mature conversation if that broke 8 years ago, 9, 10 years ago, and that reinsurer probably might not have, for one, there might not have been the data and the granularity of that data to really get into the nitty gritty of what am I actually offering with this aggregate cover here? What was it really covering? Am I really getting to an actuarially sound idea of what the probability of a loss is on this cover? It sounds like it's a much more mature conversation because, of course, both sides have really learned a lot more about these covers and how they really work.
Yeah, that's absolutely true. I always like to categorize the aggregate covers as art meets science, and it might be a lot more art in a lot of cases than it is science or analytics or data. But it is true that people have gotten more sophisticated about how they think through and the types of analytics involved in delving more deeply into view of risk. And that's true for both buyers and sellers. The trickiness of that is we've had a fairly dynamic and shifting set of forces on what impacts view of risk. So you can't just pop something into a standard off-the-shelf model. And we could be talking about any line of business at this point. You can't just pop something into that off-the-shelf model and press a button and have your answer come out. View of risk has become a pretty bespoke thing and much more sophisticated than if we go back 20 years, what people were doing.
Overall, in terms of reinsurers being happy to give something to get something and still have something that they believe is going to drive economic value to them and exceed their cost of capital, something that they're going to be happy with, would you have any estimate of how much lower are their return hurdles today than where they were this time last year?
Yes, so that's a great question, Mark, for you as a journalist, and not
and
one I'm going
answer.
to give you specifics around. It is very hard to answer. And part of that is because view of risk is such a customized or bespoke thing depending on who you're talking to. So that appreciation of what the future return is going to be on the business I just wrote is heavily dependent on what in fact my view of risk is, which tends to be different for everybody in the segment. So it's a really tough question to answer, other than to say, we know we had a very profitable and successful 2025, and there was room for some tightening up and adjustment of the pricing parameters going into 2026, which is what we saw happen, to still leave us at that point in the cycle where you have adequate rate to allow reinsurers to continue forward profitably. And it's like I said before, it's a good place to be. It's a difficult place to hold as a point in time.
It's always changing. It never stays the same. A report is a static snapshot of a moment in time, but the market itself, of course, is always moving. Obviously, I'm going to ask you about where you think things are going for the rest of the year and where the momentum is. But before we do that, there's a couple more things I think we need to talk about. ILS, we've had 2025 had another record year of issuance, and therefore coming on previous record years of very strong years of issuance. So now we're looking at a limit outstanding in the cat bond market, particularly that is larger than it's ever been before. How's that affected the dynamics of the market? Was it something there? Perhaps the last time more traditional reinsurers from 2012, 2013, 2014, 2015, when ILS was really on a growth spurt, perhaps the market was more of an us and them type market back then. People saw themselves as either traditional reinsurers or non-traditional reinsurers or alternative capital people, and that this sort of never the twain shall meet. Perhaps I think things are better integrated now. But having said that, as a broker, having that really healthy ILS contribution, did that give you something else to better leverage, something to play with, or change the dynamics of the marketplace?
What you just said actually was something somebody brought up to me yesterday about this dynamic from years ago between ILS capital and traditional reinsurers being so black and white. And the person I was talking to yesterday raised the issue to me of a reinsurer panel that we had hosted. And again, this was a number of years ago. And I'm not going to name any names, but it was an ILS capital provider and a traditional reinsurer on the panel. And it was, and people who were there will remember this, it was one of the most explosive panels I was moderating because of this tension between how traditional reinsurers viewed ILS capital and the way that ILS capital viewed operating in the reinsurance space. And the fact that those two things were not particularly compatible at that point in time. So if you fast forward to now, we have just come such a long way in reinsurers really thinking through the dynamic of where capital comes from and how they leverage it throughout their own value in the value chain, right? And for ILS capital, how that capital finds a home that has access to business and professional underwriting talent and is able to deploy capital coming in from a variety of sources in really attractive and professionalized ways. So we see this incredible blurring of the lines these days. To get back to your question on ILS itself, ILS has always been an incredible catalyst in driving the way that the reinsurance market responds to the needs of buyers. And going all the way back to really when it was just solely a property play and having that additional capital come in and reshaping the way the industry thought about accessing that capital and the way that reinsurers thought about also accessing and leveraging that capital. It's been a force driving change in the industry. The really fascinating thing about where we are now is we've reached a point in time where ILS capital continues to expand what it influences within the reinsurance sector. So on the property side, we've seen expansion of perils and types of structures, and they're getting to be in more and more flexibility around the types of things you can package into an ILS vehicle and attract capital to participate on. But then we also have to look at the expansion to things outside of property. It was just a few years ago where the first cyber cat bond was completed, and it was a pretty tiny amount of limit purchased that way. And people thought, oh, well, isn't that cute? That's kind of a lark. And what's the point of even doing that? Well, the point of doing that is you introduce the market to a peril that's expanding and is going to need coverage, is going to access coverage in that way through the ILS market going forward. And now we have $300 million plus cyber cat bonds in play. And that's not even to touch on the long tail expansion of ILS now moving into that space and the number of deals that were being looked at around January 1 on the long tail side as well.
So it sounds like it's far more of a complementary force, whereas 15 years ago, it could have been destabilizing, even though it might not have intended to be, just the way it was perceived. As a broker, it's quite nice to have an invisible competitor out there you can always sort of threaten. So, well, if you don't write it, the ILS market will write it. Whereas it sounds like things are far more integrated these days. So it's less of a worry. Whereas 15 years ago, if we'd seen ILS expanding at this rate, then traditional reinsurers might have said, I'm slightly worried. Have they come to eat my lunch? It doesn't sound like that's the case anymore. It sounds like we're all trying to make a bigger cake, bigger lunch for all of us to eat. It's not something that is destabilizing?
I think both things might be true, Mark. I agree with you. It's not destabilizing, but it is a competitive force within the industry. So it is another source of capital that adds to that abundance of where you can access the types of limit that you want. And it gives a little bit more diversity into the way that capital is coming into the space. It also gives more fluidity as to the way that capital is coming into the space. If we look back post KRW, it took forever to recapitalize in a way that really had a meaningful impact on how we could go out and find additional limit for people. And I mean, those were dark days. And if that same dynamic happens today, we just got a lot more sources of capital and access to bring that into the space, also in ways that are very professionally managed.
More capital is more capital, and that's just more supply ultimately. And what about the balance between, we've been talking a lot the last couple of years about the balance between appetite for property risk versus casualty risk, particularly in the US. Did that change? Obviously, casualty was relatively flat, US casualty reinsurance. Was that indicative of that continued debate ongoing about the ultimate adequacy of that US casualty business? Or is it just, do you think now, is that now the final shoe that will drop? If everything else was down 15, this is flat. Is it just that appetites will take longer to shift in casualty?
The jury is still a bit out on US casualty, and there's a fairly wide range of opinion out there with people who are supplying that limit, the sellers of capacity for casualty. There isn't a one size fits all, yes, we think we're here in the cycle kind of answer. There are definitely differing opinions on, have adjustments been made that bring us to a point where things are corrected, or are we at a point where we're not quite sure? Because things like the way claims are settling out, they're shifting, they're accelerating. So is that indicating that these recent years are actually going to get worse than we're expecting? Or is that indicating something else? Is that indicating that there's a greater degree of proactiveness on the part of people that are being exposed to those claims and settling those claims? And that's actually creating different patterns of loss settlement that we now have to try to navigate and judge as to where ultimate loss picks end up. There just isn't a one right answer that we've come across.
And in terms of that fluidity of these things, do you think the tendency is generally towards greater confidence over time? Do you think that it's just one of these things that takes time? Because, of course, again, you can't see the results.
That's exactly right. So every quarter that we go through gives us another data point to say this development pattern is supporting this type of theory around where we're going to end up in a year or 2 years or 3 years. But until we've seen enough of those data points, there's going to be debate around what the right analysis is. That mechanism, that dynamic, that discussion that's happening in the buying and selling of that risk has led to a couple of things. One, much greater scrutiny of the data for individual companies that have really done a tremendous amount. We were talking earlier about reshaping portfolios and the things that insurance companies have had to do. Well, the casualty writers have had to do an absolutely tremendous amount of work on their portfolios. And they have, but that work goes deeper than just how the product is priced and structured. It also goes to how they're staffing their own claims and legal departments, how they're responding to losses as they're coming in the door. So there's a whole new range of information to have a conversation with a reinsurer about what's actually happening at the company. Those conversations take time. They get into detail. They require a lot of data. And the buyers that are able to get into the greatest granularity around the impacts they're seeing in their own portfolio and the types of responses they've had are the buyers that are best positioned to access the capacity in the casualty space.
It doesn't sound like any two of these renewals are the same, because each of these companies they're revamping even in the saying, right, we've doubled the size of our claims department, or we've become far more proactive in claims. We used to be more passive, we used to wait for the writ to come, and now we go out and try and settle quickly, or whatever. It sounds like this is it's been a real catalyst for everyone to think of a new solution, and obviously none of those solutions will be identical. So it sounds like it's very hard to talk about it in aggregate, which is what I'm trying to make you do. But
yeah, that's true. It is right that throughout this whole process, we've ended up for US casualty essentially flat. A little bit of movement up or down one way or another, depending on the individual renewal discussions and the positioning of each cedent. The other part that's true about the casualty renewals is once we got to a point with the core reinsurers on a given account, there was plenty of capacity to support deals. So buyers for casualty weren't necessarily running into the situation where they structured something that they felt was the thing they wanted to buy and then couldn't find any capacity to support it. That just wasn't the case. So this idea that there's plentiful capital throughout the industry also has applied to casualty. It's just been a more cautious approach to getting to the pricing and the structures.
Plentiful capital, but not plentiful consensus.
Yeah, that's a good way to put it.
So let's start looking towards the future. Obviously, New Year's over. We're into 2026. As you're setting the scene for 1st of April, 1st of June, 1st of July, how are you preparing yourself and those clients?
So the first thing that we think about when we're looking at the renewals ahead, are there any sorts of influences on those renewals that would create scenarios that differ from what we just went through at January 1? And right now, today, at this point in time, while you and I are having this conversation, there really isn't any reason to think that the amount of capacity available in the sector, the desire by reinsurers to continue to deploy their expanded capital base back into the reinsurance sector is going to change. So from that perspective, I think if you're a buyer at April or June or July, thinking about the way you want to approach your renewal, you should be planning for abundant capacity. You should be planning for reinsurers who are very receptive to having more in-depth conversations around additional coverage you might want to buy, or thinking a bit more creatively about structuring a solution based on the way that you've now gone through and perhaps made changes in your own portfolio. So I think that's a really positive and productive way of thinking about the upcoming renewals. The other thing that we're waiting to see, and you mentioned the savings that the January 1 buyers had experienced, and there's a question now going into the rest of the year, as those buyers think about what to do with those savings, are we going to see some of that coming back to the reinsurance market to test the waters on some additional supplemental coverages?
Also, some of those savings, will they go into being more competitive on insurance? Of course, we've seen it before. Less expensive reinsurance can mean less expensive insurance and more competitive insurance market.
Well, that's absolutely true. And in certain cases, there's even a direct correlation or more of a specified market dynamic around that, where in cases the buyers are able to integrate their reinsurance costs directly into the way that they file rates and price the business. That can get complicated and murky with all of the things that impact the way primary rates are set, of course. But all things being equal, if reinsurance pricing is coming down, it's a benefit across the board.
It's all about momentum. It sounds like the momentum is going to continue, barring a big change. So as a reinsurer, would you be expecting any kind of tempering at this point to say, well, okay, look, I was happy to give, what I gave. And it was slightly more than I was expecting. I gave a couple of years worth of discounts in one go. Do you start to feel there might be any resistance?
Okay, so that is a great point that you bring up, Mark, because we did at January 1 find a definite point beyond which reinsurers weren't interested in deploying capacity. So
that's your job.
Well, that's a great point, right? And we do our best to earn it.
Because if you don't do it, somebody else will find it.
Right. But I do think it's important to acknowledge the fact that reinsurers weren't just happy to say yes to anything and everything that came across their desk. They are still very much remembering what they went through a handful of years ago, and the fact that not being profitable in the reinsurance community, it's not sustainable, and it doesn't create a healthy buying and selling environment for anybody. So there is underwriting going on where the reinsurers are very much aware that there is a threshold beyond which something just becomes not attractive. We do see, though, that that's really dependent on what have the past renewals for that particular scene looked like? What is the current perceived pricing adequacy? Are there things that they're asking for in terms of structure or coverage changes that the reinsurer is much more sensitive to than a fluctuating price? So as we move into mid-year renewals, I think it's reasonable to stress that this isn't anything goes, that it is still very much the memory of having to underwrite to be profitable is the goal that each reinsurer needs to fit within their business planning.
So it seems like the discipline's still ultimately there. And I suppose ultimately it's not good for anybody. We've all met reinsurers or any insurers in either side of the market. We sort of all have the same gut feeling that they're not writing sustainably. And lo and behold, 2 or 3 years later, they're not there anymore. And then we're left holding, trying to get those claims paid and trying to replace that capacity. And things are unnecessarily complicated. And we all know, suppose, if something isn't sustainable in this business, it doesn't say unsustainable for very long necessarily, does it? So that's reasonably heartening news. So on that, it would sound like some of those readjustments, that the resetting of the attachment points and some of those things are still fairly sacred. One would assume that we wouldn't be expecting to go back to the sort of terms and conditions that you would have been able to get 7 or 8 years ago.
So we're certainly seeing a lot of the structure sensitivity hold up. And I wouldn't want to underestimate the amount of impact that that's had throughout the entire insurance reinsurance chain. Not only did prices adjust because of the way that losses were being sustained both within insurance and reinsurance, we were never going to be able to price ourselves out of the difficulties of that market. And so structural changes had to be part of the solution. And that's occurred now in both insurance and reinsurance. And the fact that it's impacting the entire value chain puts us where we are with both insurers and reinsurers right now at a point in time of general profitability. So as we look forward, on both the insurance side and the reinsurance side, there's going to be a level of sensitivity maintained as to what created the problem in the first place and what got us out of that situation into a marketplace that can be healthier and responsive to all buyers' needs, including the original insureds.
Looking at those reinsurers, they wanted to grow, rightly so. If they're going to make 17 to 18% return on equity, who wouldn't want to grow with those kind of returns on offer? Obviously, one would expect that the prospective returns on offer are lower. We won't be able to quantify until after the event. If a reinsurer is looking to grow now, would you be expecting to see more of them looking to grow via M&A rather than phoning up and asking you for lots of new business? So, well, actually, maybe instead of the new business that Lara's got for me, I might, if I took over my neighbor, would I be on a better potential return on equity for me?
So look, as we talked about, there is a lot of capital out there in the sector right now, and there are only so many things you can do with your capital. And you can write more business, but as we talked about, at this point in time, at least, that demand isn't growing as quickly as the capital that's available to support it. So yeah, absolutely. Would any of us be shocked if there are companies looking for other ways to grow? No, of course not. And I think that's very much on the table for 2026. We will all see what happens.
Lara, is there anything that we haven't spoken about so far that you think we definitely should?
Well, Mark, I think that we could probably continue this conversation for another couple of hours, but we've covered a lot of ground, and I don't think there's anything wildly critical that we haven't touched on.
No, I think you're very right. But you're certainly right. I could carry on chatting to you for at least another couple of hours, Lara, and always look forward to these conversations, and hopefully we can have at least another one at Monte Carlo, and if not before. It's always extremely valuable. I find it a very, very useful deployment of my time to talk to you. And any time I can spend talking to you is time very well spent. So thank you, Lara. Thank you so much for this update. Everybody, make sure you read the report, the links at the end of the podcast. But until then, thank you so much, Lara.
Thank you so much, Mark. Thanks for having me.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this program. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.